Welcome to the fourth lecture of the financial market and institutions. Today our topic is what is financial institutions or intermediary, their functions and types. So already we studied the functions of the financial institutions like transactions, cost and risk sharing. We discussed in the previous lectures in details. So I will go to the definition and explanation of the financial institution or intermediary and what are the different types of the financial institutions. So what does it mean by financial institutions or financial intermediary? So financial intermediary or financial institutions are those which play an intermediary role in the financial markets. Intermediary role means the third party role. They channelize the funds from lender to borrower, or we can say that from savers to borrower. If we have some savings, so we directly go to the bank and deposit that money in the bank. Bank not keep that money with their self. Further they channelize in the shape of individual loans or to business loan, and similarly they can also use that funds to buy different types of the securities. So in this way fund is channelized from savers to borrowers, and hence these funds they are circulating in the economy, which leads the economic developments. So financial institutions are those institutions or firms or business that provide services as an intermediary in the financial markets, and they can transfer the funds from investors to companies who need of these funds. So such institutions or such intermediary are called financial institutions. In Afghanistan, common examples of the financial institutions I will give you. Bank. Bank is a type of financial institution or financial intermediary. Hope you will understand the financial institution or financial intermediary. Now comes towards the types of the financial intermediary. So we divided the financial intermediary into three main categories, and why we divided these intermediary or institution into three categories? We divided these on the basis of that from which source they are generating their funds and for which use they are using those funds. So on the basis of these we divided the financial intermediary or financial institution into following three categories. First one is depository institutions, second one is contractual saving institution, third one is investment intermediary. Now one by one we will discuss it. Our first one financial institution is depository institution. So depository institution is a financial institutions which generate their funds by accepting deposits from individuals and other institutions or business and make those deposits as a loan. These institutions includes commercial banks. They are also called thrift institutions, savings and loans associations, mutual saving banks and credit unions. Now, why these are called depository institution? First of all, what is deposits? So look at when savers give the money to bank. So this is called deposits. Like you have a bank account and you have some surplus money. You give that money to bank. This money, when you add to your account, this is called deposits. So deposits institutions like banks. Banks, they don't have their own sufficient funds. They accept money from individuals like me and you peoples. Similarly, they are also accepting money from the businesses. Most of the business, they are not keeping money in cash form with their self. Their deposits, the business deposit that money into the banks. So that's why depository institutions are those institutions whose main source of generating fund is accepting deposits. So when they accept those deposits, they are not keeping that money with their self. Further, they channelize that money in the shape of loan to individual or to other businesses, or they invest in the different financial institutions, like they buy the bonds, they buy the shares, they buy the commercial papers, etc. and etc. So depository institutions are those institutions which accept the deposits and further channelize those deposits. Depository institutions further divided into different types. So first one type is commercial bank or banks. You studied and you learned the banks in 4th semester in the money banking subject. So commercial banks, bank is a financial institution which accept the deposits at low interest rate, lends those deposits at high interest rate, and as well as providing different services to generate their revenue. Commercial banks are what? These are the financial intermediary. They raise funds through by accepting deposits. They accept deposits in shape of current account, saving account, fixed deposits or term deposit account. They offer these choices to the depositors. and in this way they are generating funds and channelize those funds further to make business loans or individual loans or mortgage loans, and in this way they are circulating the funds. The largest financial intermediary in the financial environments are the commercial banks, and they have most diversified portfolios of the assets. Second one is mutual saving banks. These are also called saving and loan associations. Mutual saving banks are those depository institutions of which there are approximately 1,500 branches in the United States. These mutual savings banks obtain funds through by saving deposits. They are also called shares, in which way they are accepting the deposits, so they are also called the shares, and time and checkable deposit as well as they are accepting. In the past, these institutions were constrained in their activities and mostly made mortgage loans for the residential housings. Means they make their investment in the shape of mortgage loans. When they generate the funds through by accepting the deposits, so further they channelize that funds in shape of mortgage loans. Over the time, these restrictions have been loose, and that the distinctions between these depository institutions and commercial banks has blurred. Both now mixing, have providing the same situations. So the mutual saving banks more like are now just like a commercial banks. Keep in mind, when mutual fund saving banks they are accepting the deposits, so there are no shareholders in these institutions. Is the main source of the funds of these institutions are accepting the deposits, so that's why these are comes in the depository institution, in the types of depository institutions. Third one types of the depository institution is that is credit union. What is credit union? These financial institutions are very small cooperative lending institutions. The credit union members are employees of particular firms. They acquire funds from the deposits called shares, and make consumer loans. Look at, dear students, credit unions, their main source is accepting deposits. They are also called shares, and further channelize those deposits to make consumer loan. The banking legislations in 1980s, according to that, credit unions are also allowed to issue the checkable deposits and can make mortgage loan as well as with the consumer loan. So now it is the credit union, when they generate their funds, so they can channelize that funds further in shape of consumer loan and mortgage loan as well as. I use a word, checkable deposits. So what does it mean by checkable deposit? Checkable deposits, that is a technical terms for any kinds of demand deposits account. This is a demand deposit accounts which is used against which the check or draft of any kind may be written. Means that checkable deposits is that any time the owner can withdraw funds from their accounts on demand without any prior notice. So credit union, that is a non-profit financial institutions that is owned and operated entirely by its members who made it. So those persons are called member of the credit unions. Credit unions mostly that is made by different large corporations and large organizations for their members and all those employees who are working here to financially helps the members of these unions. All the members are also the owners, but they are called members, not the owners. It's charge a very less amount of interest on borrowing. So the main aim of these unions are to give financial support to different corporations. Is their main sources of generating funds is the deposits of the members. So that's why these are comes in the category of the depository institutions. So depository institutions, now you will understand better that those institutions which accept deposits and further channelize it, their main sources of generating fund is accepting deposit. Look at this one. This is a type of the intermediary, so depository institutions. This is the source from where they are generating funds and where they can use it. So look at depository institution. First one is commercial banks. So their main sources of generating fund is what? That is, if you looked out, so the main sources of generating funds of the depository institution is accepting deposits. They are accepting the deposits. Here, look it. And further, when they accept those deposits, so where they channelize those deposits they are channelized where? In business and consumer loan, mortgage loan, municipal bonds, etc. They are buying the securities and etc. Second one, mutual saving banks. So again, their main sources of generating fund is deposits. And further, they channelize those deposits as a mortgage loan. Similarly, credit unions. What is their main sources of generating funds? Again, look at main sources of generating fund is accepting deposits. And further, they channelize those deposits in shape of consumer loan. The contractual saving institutions I will discuss in the upcoming class session, inshallah. So for now, this is enough, and we'll see you inshallah in the next class.